On May 16, 2025, Moody's Investors Service made a historic move, one that hasn't happened in over a century. The United States, long seen as the bedrock of global finance, was stripped of its pristine tabule credit rating. Downgraded to AA1, America now joins a growing list of advanced economies struggling to maintain fiscal credibility in an era of explosive debt and political dysfunction. This is more than a financial rating. It's a verdict on leadership, policy, and the long-term direction of the world's largest economy. And it's not an isolated warning. It's the third and final blow in a trilogy of credit downgrades. Standard & Poor's was first in 2011. Fitch followed in 2023, and now Moody's has confirmed what many investors already suspected. The US fiscal position is no longer beyond question. Let's unpack what this means, economically, politically, and geopolitically, and why this downgrade is a moment of reckoning for the 21st century financial order. First, the core reason for the downgrade, the debt. The United States is carrying more than $36 trillion in federal debt, a figure that has risen nearly 40% in just 5 years. The Congressional Budget Office projects that if nothing changes, the debt-to-GDP ratio could surpass 134% by 2035. That puts the US on a trajectory similar to some of the most indebted countries in the world, without the benefit of external creditors to bail them out. Why is this debt unsustainable? Because of interest costs. In 2024, the US government spent more money servicing debt than on national defense, more than $1.1 trillion in interest payments alone. And this is just the beginning. As older, lower-interest debt matures and is replaced with higher-yielding bonds, those payments will grow. Moody's estimates that by 2035, nearly 30% of federal revenue could be consumed by interest expenses alone. Second, persistent fiscal deficits. The US has not run a balanced federal budget since 2001. The deficit for fiscal year 2024 was 6.4% of GDP, and that figure is projected to climb unless major reforms are implemented. Entitlement programs, Social Security, Medicare, Medicaid, now represent over 50% of government spending. Add to that defense, education, infrastructure, and discretionary spending, and the numbers simply don't add up. Third, political paralysis. Moody's pointed out that successive administrations, both Republican and Democrat, have failed to pass meaningful fiscal reform. Proposals to raise revenue or cut spending often stall in Congress. The 2025 budget negotiations became emblematic of this dysfunction. President Trump's proposal to extend the 2017 tax cuts was projected to cost $4 trillion over the next decade. It failed in committee, exposing sharp partisan divides and a lack of consensus on how to address America's ballooning deficit. But what does this downgrade mean in practical terms? Credit ratings matter because they influence borrowing costs. With a lower rating, US Treasury bonds are now officially deemed more risky. That risk translates into higher yields. Already, yields on 10-year Treasuries have crept above 5%, the highest since the early 2000s. That means more expensive mortgages, costlier business loans, and greater debt servicing burdens for state and local governments. Moody's downgrade also erodes confidence. The United States has long been the benchmark of financial safety. Its treasury bonds are used as collateral in global finance. Its dollar is the world's reserve currency. A downgrade calls those assumptions into question. So far, the market response has been muted. The US remains a financial superpower. Treasuries are still in high demand. The dollar is still dominant. But the long-term implications are significant. We are now in uncharted territory. For the first time in history, the US holds no A+A rating from any of the three major agencies. This could mark the beginning of a slow erosion of financial dominance. Globally, this downgrade will fuel the rise of alternative systems. The BRICS alliance, Brazil, Russia, India, China, and South Africa, has been aggressively pushing for a new financial order. Their recent launch of an AI-powered cross-border payment system aims to reduce reliance on SWIFT and the US dollar. The Moody's downgrade will be seen by these countries as validation of their argument that the current Western-led system is fragile and needs reform. China, in particular, has reacted swiftly. In an official statement, the People's Bank of China said it was reviewing diversification strategies for its foreign reserves. While Beijing has long held over $800 billion in US treasuries, the pressure is growing to shift toward gold, euros, and yuan-based assets. If that trend accelerates, demand for treasuries could decline and yields could rise further. Europe is watching too. EU finance ministers met in Brussels the day after the downgrade to discuss its implications. The Eurozone is grappling with its own debt issues, but some see this as a chance to push for a more central role for the euro in global trade settlements. Let's return to the domestic consequences. For individual Americans, the downgrade may seem abstract, but its ripple effects are real. Higher government borrowing costs will lead to higher interest rates across the board: mortgages, credit cards, student loans. This will put pressure on consumer spending, which accounts for nearly 70% of US GDP. For investors, it's a wake-up call. While US equities may not crash immediately, long-term asset allocation strategies may begin to shift. Pension funds, sovereign wealth funds, and institutional investors could start reducing exposure to US government bonds in favor of more diversified global portfolios. Some investment firms have already issued warnings. BlackRock and Vanguard noted that the downgrade may trigger automatic rebalancing in certain bond indexes. That could force some passive funds to reduce their exposure to US treasuries, even if they remain bullish on the US economy. And then there's the political dimension. The downgrade adds fire to the ongoing 2026 presidential campaign. Republican leaders blame Democrats for excessive spending. Democrats blame Republican tax cuts and resistance to entitlement reform. But the reality is clear. Both parties have contributed to decades of fiscal irresponsibility, and voters are increasingly disillusioned with the status quo. So what can be done? First, serious bipartisan reform is needed. That means rethinking entitlement programs, revisiting tax policy, and reintroducing budget caps that were dismantled in previous years. Economists suggest measures such as raising the retirement age, implementing wealth taxes, reducing military expenditure, or enacting carbon pricing mechanisms to generate revenue. Second, improving fiscal governance. Independent watchdogs have called for the creation of a congressional budget office with enforcement power. Right now, the CBO is an advisory body. Giving it authority could help ensure that future budgets adhere to long-term sustainability metrics. Third, embracing technology. The federal government is notoriously inefficient in its use of digital tools. Investing in AI-powered auditing, fraud detection, and program optimization could save billions annually. The IRS, for example, could recover nearly $200 billion in unpaid taxes each year if properly digitized. Fourth, restoring credibility. The world doesn't expect the US to eliminate its debt overnight, but it does expect a plan. Just announcing a credible, phased roadmap to reduce deficits over the next 10 to 15 years would help restore investor confidence. What about the US dollar? Despite the downgrade, the dollar is unlikely to be dethroned overnight. It still accounts for over 58% of global currency reserves, and nearly 90% of forex transactions involve the dollar. But cracks are forming. More bilateral trade agreements are being settled in local currencies. Central banks are hoarding gold at the fastest pace in 50 years. Digital currencies, whether state-backed or decentralized, are gaining traction. If the US continues to ignore these shifts, it may face a scenario where the dollar's dominance gradually fades. Not because another currency replaces it, but because a multipolar system emerges where no single currency is king. Finally, let's look at the big picture. The Moody's downgrade is not just about numbers. It's about trust. It's about whether the most powerful nation on earth can manage its finances responsibly. It's about the future of global finance, economic leadership, and international cooperation. It's also about time. Time to act before markets do. Time to reform before collapse. Time to show that leadership isn't about slogans, it's about choices. Difficult, often unpopular, but necessary choices. Because history shows us what happens to empires that ignore their debts. They fade. They lose influence. They decline. But history also shows us that renewal is possible if the warning signs are heeded. The Moody's downgrade is a warning. It's up to America and the world to decide whether it's a turning point or just the next step in a long, slow slide. If you value independent financial insight, long-term perspective, and real talk without hype, subscribe to our channel. Let's understand the world together, one major event at a time. Subscribe to AI Finance Mastermind and stay informed with expert-level finance and AI insights every week. Disclaimer: this video is for educational and informational purposes only and should not be considered financial or investment advice. Always do your own research or consult a licensed financial advisor before making investment decisions.